This trading week before the Easter holiday is going to be short, so markets have turned attention to comments from monetary authorities. The crucial news of the week ending the first quarter will, of course, be inflation reports in the world's largest economies. Ahead of these reports, the market is taking a short break. Financial markets in the United States and other countries will be closed on a Good Friday, but inflation data in the United States will be released on that date. The PCE price index is believed to be the Federal Reserve's preferred indicator. No doubt, the data will certainly influence market sentiment. Analysts project the general and core consumer price indexes to reach 2.5% and 2.8% respectively. At the same time, acceleration by 3% or higher will certainly be an argument for the central bank to hold interest rates at elevated levels for a while. Moreover, U.S. new home sales data released on a Monday, as well as today's durable goods orders, suggested that the U.S. economy is doing exceptionally well and inflation remains high. Orders for durable industrial goods in the United States rose by 1.4% in February from a month ago. Moreover, they not only exceeded forecast of a 1.1% increase, but also were downgraded from a minus 6.9% in January. Federal Reserve Chairman Jerome Powell has repeatedly warned in his speeches that the rate cut will not be as fast as the markets expect and will be quite thorny. In general, comments from the Fed policymakers this week remained hawkish. For example, Atlanta Fed President Raphael Bostic said he believes that there will be only one rate cut in 2024. Lisa Cook, the top governor of the Federal Reserve, spoke in favor of a more cautious approach that should ensure a sustainable return of inflation to 2%. The colleague Austin Cosby of Chicago is among policymakers advocating for 3 interest rate cuts before the year end. And this stance coincides with the median forecast of the Fed's policymakers, which calls for a 75 basis point rate cut in 2024. The comments were likely responsible for a slight recovery in some dollar pairs during the New York session on a Monday, and today Japan's authorities carried out their regular ruble intervention. Japan's Finance Minister Shunichi Suzuki said he would not rule out taking some measures to deal with the weakening yen. For this reason, he repeated the warning that Tokyo's leading currency diplomat Masato Kanda delivered yesterday. At the same time, experts point out that the yen is weakening despite market fundamentals, and this is certainly not true because the currency that is backed by a high interest rate makes the most profit. High interest rates over a long period of time are a bullish factor for the US dollar, since it attracts a greater inflow of foreign capital. However, on the back of looming Forex interventions, the dollar-yen pair is still facing strong resistance today near 152. While US monetary policy remains more hawkish in Europe, on the contrary, representatives of central banks are making softer statements. Firstly, several officials from the ECB Governing Council have hinted at the possibility of an earlier than expected rate cut. For example, Maris Mueller said today that the moment when the ECB can start cutting rates is already approaching. ECB chief economist Philip Lane is confident that inflation is on a track to the target of 2%, and this the gap between the prospects of the Federal Reserve and the European is widening, thus pushing the euro-dollar pair down. However, a sell-off last week has already priced in this policy differential, a pullback of the US dollar which seemed quite the beginning of a full-fledged correction yesterday did not develop further. The market in general is trading sideways, and the US dollar index is set to hold the upper hand over 6 major rivals as the US economy outperforms other countries. In addition, the US dollar is sure to rise because other central banks are more dovish than the US Federal Reserve. Therefore, today the greenback still remains above the 104-point level. On the other hand, the US dollar still remains significantly overbought, hence the downward correction resumed today due to profit taking and partly under pressure from a slightly strengthened yen. The US stock market is also keeping pace with the US dollar, while Street's benchmark index has already gained 9.4% since the beginning of the year. However, the S&P 500 has slowed down its rally. In the early New York session, the index was again trading higher in the intraday corridor between 5,227 and 5,235 points. By the way, based on the results of 2024, Goldman Sachs experts predict growth for this indicator to 6,000 points. Amid the pullback of the US dollar, the euro also perked up. The euro-dollar pair showed gains today within the intraday corridor between 1.0839 and 1.0867 as the traders took profits after last week's volatile sell-off. After all, the difference in rhetoric of the Federal Reserve and the ECB suggested that the euro's weakness is realistic. At the same time, the US dollar is likely to consolidate rather than stage another rally. In any case, the euro-dollar pair reversed upward after a downward cycle and even tried to test the resistance of 1.0865. Taking into account the scale of the euro's weakness and the same fundamental factors, the recovery stage of the euro will be short-lived. Today, the fall of the US dollar encouraged growth over oil prices. Bearing in mind the jump of 1.5%, we conclude that Brent Crude has ended its 4-day retracement. However, the bullish cycle will be confirmed when the price updates the local high around $87.50 per barrel. Until then, Brent Crude is likely to trade sideways. In addition, oil prices are supported by concerns about a reduction in the supply amid a decline in oil output in Russia and geopolitical conflicts. Therefore, the benchmark Brent not only rose yesterday, but its price also completed a corrective movement. At least such signals are given by technical indicators, but there were no fundamental reasons for such a movement in the chart. Data that could influence oil prices will be available today. If the American Petroleum Institute reports a decline in the U.S. oil inventories, oil prices could resume an uptrend. You have watched the market review by InstaForex analyst for Tuesday, March 26. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. So see you online tomorrow.